Well, Mike, would you believe it? We are halfway through this year. It is, well into July at this point, and I frankly can't believe it. I don't know about you.
Oh no, it flew by, but I think that happens as we get older. Each year goes by quicker and quicker.
And I am feeling my age today. Another week of no sleeping with little ones at home. So, thanks everybody. Thank you for joining us. This is our Friday Live. We get together to talk about the markets. This is a special episode today. We've got, pretty much our half year recap, and it's been a pretty exciting story, Mike. It's been something we've been talking about week in, week out. There's been a lot of changes made in the portfolios since the beginning of the year. There's been a lot of different elements you're tracking, obviously keeping a tight eye on rising interest rates, but there's been so many different factors that have contributed to our positioning over the years. So that's what today's episode is about. We're going to let Mike do his thing. We're going to listen to the story the market's told us, where it started, kind of what happened midway, and where it ended up the first half of the year. So that's the theme for today. And along with that theme, we're keeping it pretty casual, right? It's summer. Everybody knows nobody in finance works on Fridays in the summer. So we're keeping it light, keeping it fresh, and we're going to have a great episode for you today. So as always, thank you guys for joining us. Nothing I talk about or Mike talks about, the smarter one over there on the other side of the screen, is it's not specific advice, not for you, not for your friends, not for your cats, not for your dogs, right? If you need investment advice, you shouldn't be watching a Facebook Live video. You should seek out a qualified professional. Hopefully you figured that out by now. Mike, what story has the market told us so far? That's obvious. It's a little broad. What did we start out the year like? Maybe is a good place to start. What were the hopes and expectations going into January of this year?
Yeah, so 2023, I'm calling it as the year that the most anticipated recession has not happened, at least yet.
Now, that's a coined phrase to everybody, okay? Don't go repeating that. That is a coined phrase.
So coming into the year, there was plenty of reasons to be pessimistic, bearish, whatever you want to call it. The economic data was not trending in the right direction. Inflation was way too high, and the Fed was on a war path. So in the past 14 months or so, the Fed has raised their Fed funds rate by five percentage points. So that is pretty much either the most or top two most aggressive rate hiking campaigns that we've ever experienced in the United States.
Oh, it's been an insane amount of rate hikes. I mean, if we go back to the last time this happened, I'm trying to remember the guy's name, and it's completely escaping me. Volcker. Yeah. Thank you.
Powell's hero.
Powell, yeah. Well, I mean, right. It makes sense. Powell said for a long time that Volcker's his hero, and we're seeing a very similar pattern. Now, Powell's really struggling though, because Volcker was successful at putting us in 2 recessions, and we're still trying to get in one here.
Yeah. So it's been a while since I studied that time period quite a bit through mid last year. And yeah, there was 2 recessions. Max drawdown, I think, through that whole period was about 27%. Pretty similar to what we saw in the fall. We just didn't have the recessions coincide with it. But I think I want to say it was a different targeting mechanism, but he pretty much took the rates from 10 to, I think, as high as 20% at one point. But there was a lot of fluctuations throughout that whole cycle in what they did with policy rate. Powell's trying to prevent the Fed from doing that kind of thing, where it's raise one meeting, lower the next meeting.
Yeah, that's some stability. At least like a consistent pattern seems to be a healthy thing for U.S. consumers, and I think that's good to see. We're not doing the ups and the downs. Just our painful trend upwards to stomp this is plenty enough for me. Well, why don't we take a quick step back, right? And I think, Mike, something that gets thrown around all the time that maybe even we don't even have, folks watching might not even have a clear understanding or a definition for what, in the simplest terms, what is a recession?
There's different definitions of it. Some people classify it as 2 negative quarters of GDP, which we did have. That's not really the true definition, it's really a broad decline across various economic metrics that include employment, spending. Those are the main ones, manufacturing. So we just haven't seen that broad decline yet. We are in the midst of what they call an earnings recession. We've had two negative earnings quarters, and we're looking, I think this quarter is expected to come in at like -8% decline. So, but overall, we're not in a recession yet. Actually, we've seen some improvement, but basically, when the Fed raises rates that much, it's always caused a recession, and we just have not seen it yet. And there's really a couple reasons behind that. And the pandemic created a different environment than we've ever experienced in the past. There was just a flood of stimulus, both on the government, the federal government side, and monetary policy. So they threw a bunch of stimulus out to people, really increased their excess savings. Corporations all refinanced at 0% interest rates. So typically, when the Fed raises interest rates, it causes strain on the housing market, which we did see. That's seen some stabilization and growth. It slows down business spending because those corporations need to refinance debt at higher rates, and it's not as great of an incentive to do that. So that kind of mechanism just slows down the overall money supply. And we have seen a decline in the money supply, but without it denting consumer spending or corporate spending, we just haven't seen the damage that we typically have at this stage in the cycle. Now, manufacturing has also seen weakness, but really until the consumer stops spending, and that's probably not going to happen until they start getting laid off, which that's the other dynamic that was created during the pandemic. A ton of people retired. So the supply
we still
of
have
labor,
we still have a disconnect between how many jobs we need to fill and available workers, right? And I mean, I
right?
think that
And
was
that's
a
come down,
trend.
but it's still like 1.6 jobs per unemployed worker. So we just got that JOLTS data this week, and it is delayed a month, but it declined from a little above 10 million to like 9.8. But that's still a lot of available jobs out there.
And in your opinion, Mike, what's the reason that we have so many unfilled jobs? Is it so there's a abundance of workers, but is there a lack of like qualified workers we need to fill those roles, or are companies just having a hard time filling? Because I'm not sure, you probably know the statistics better than I do, but it seems like wage growth has been pretty stagnant even in this rising interest rate environment. So I may be completely wrong. I'm not sure if you have any data on that or not.
Wage growth has been pretty healthy on a nominal level, meaning the absolute level that the pay increases. But when you take into account inflation, it's been negative for the past almost 2 years now.
It was a really nice way of you to say you're only half wrong, Colin. So I appreciate that.
Yeah. So the actually, if you look at like the working age population, the participation rate's actually pretty strong. So it really comes down to all those people that retired. We just don't have the available workers. And then companies are also a little more hesitant to lay anyone off because it took them so long to fill those jobs to begin with.
Oh, I certainly understand that. And you're just talking, I think about just conversations I've had with my friends who are generally towards the kind of the younger working years. A lot of them took jumps to higher paying positions in COVID because companies were having such a hard time filling positions. And a lot of those, or a good amount of those people, the same people I'm having those conversations with, are now in roles where, the companies aren't necessarily doing the best, but they're doing everything they can to hold on to those positions and not lay off, just like you said. And I know kind of numerous personal examples of what you're talking about there.
Yeah, and we got the most recent jobs data this morning, and it's still a pretty unclear picture. The headline payroll number came in below expectations and below last month's number, which was also revised lower. So that's showing a little bit of weakness. But at the same time, you saw an uptick in average hourly earnings to 0.4% for the month. So that takes us to 4.4% on an annualized basis, up from 4.3. So that's not something that the Fed wants to see. So in terms of the Fed, we're most likely going to see a 0.25% increase at the next meeting. And unless, there's a lot of time between now and September, but it's looking like they may go at least another 25 basis points at that point. So additional strain on the economy. Other things that could be a potential headwind in the fall are student loan payments are set to resume in October, and that excess savings from all the stimulus that people have accumulated over the past 12 to 24 months, that's coming down, and estimates are that that's likely going to be depleted by the fall. So that's going to be a strain on liquidity, as well as just the more uncertain banking environment is going to cause additional tightening there. So plenty of risks still out there, but overall the economic data is starting to improve. Unfortunately, the Fed is still going to be a headwind.
Yeah, that makes sense. So we talked about the beginning of the year, right? We went into it with, hey, bad things are coming. The recession's going to hit. And we never quite got there. One thing that we've talked about a lot is how concentrated the growth was inside of the stock indices that we follow. And, do you think that, a couple companies doing very, very well in this environment, do you think that helped, steer off the recession a bit longer and actually make the market? And when I say market, I'm talking about like the S&P 500 index. Do you think it made the market, do positively year to date so far? Do you think that overweight of returns had that big of an impact, or just kind of a side note in the whole discussion?
Yeah. So the S&P 500 index is market cap weighted. So looking at the year to date numbers, which are I think close to 16% year to date, 75% of that is accounted for from the top 7 stocks in the index. Mm-hmm. So going into June, if you take out those 7 stocks, the market was virtually flat. Now in June, we started seeing a broadening out, which was a healthier sign for the market. The cyclicals, financials, industrials, actually industrials have been doing pretty decent all year, but financials, materials, energy, they all started participating. And that was kind of 2-part. One, just kind of a bounce back trade, a catch up trade. And then, like I've talked about, economic data was looking a little rosier. So that's good for those type of industries. But yeah, overall, it's been a very market cap weighted trending market this year. You started out the year with just an offsides positioning where people are very underweight those areas like mega cap tech. Everyone's talking about they're uninvestable right now. The Fed's going to go close to 6%, and turns out they may go to 6%, but they don't care anyways. So you got a big short covering rally, and then there was some participation in the cyclicals. Defenses were doing pretty poorly, and then the bank failures started to happen, and that's really
I almost forgot about all that fun stuff. Yeah.
3 of the 4 biggest bank failures in U.S. history occurred this year.
Let's just sweep that under the rug. It doesn't really matter, isn't it?
I think we got about a 5% drawdown from that. That seems appropriate, right?
That was, honestly, when you said that, I was very aware that occurred and that happened, but that news has kind of got swept under the rug.
Yeah, and bankruptcies are actually at pretty elevated levels right now across the board in the U.S. Like recessionary levels. There's such a strong case.
There's such a strong case at every corner for that recession to come, and we just haven't seen it, right? The market has been so resilient in the face of adversity, and it is very, very interesting dynamic we're seeing.
And that's kind of a feedback loop too, because as the S&P index level goes up, even if some of the underlying stocks aren't participating, that's increasing the overall wealth in the United States. And when people feel wealthier or have more money, they're more prone to spend more money.
Yeah, I always like looking at my accounts and seeing bigger numbers than smaller ones, and then make foolish purchasing decisions based on those bigger numbers that aren't even actual money because they're long-term investments. But you got to justify it somehow.
Yeah. But yeah, so far July is not starting out that great. Kind of trending sideways, some weakness in momentum. We are pretty stretched valuation wise on the broad index level. I think we're about 19 and a half times the next 12 months earnings. So you really only trade at those levels. I think 2000.com bubble was one of them, and the post-COVID recovery was the other one. So whether they're sustainable or not, we might be due for a little bit of a pullback, but
And if you're listening, you're not quite sure, why we spend so much time looking at valuation. I'll kind of try to sum it up, Mike, and then you correct me when I'm wrong. It's really gives us a very clear indicator of when we're able to buy stocks on sale versus on a markup, right? Is that a really, really simplistic way to look at it?
Yeah.
So
and typically like year to date, like I've talked about, earnings haven't been great. They've been declining. So it's what you call multiple expansion. The earnings aren't growing, just the price is growing. So typically you only see that in accommodative monetary and fiscal policy situations where maybe the Fed's cutting rates or where those valuations make a little more sense, but not when they're increasing and becoming more restrictive. So that's a type of relationship you typically don't see. And even this week, like we're seeing a backup to all-time highs on the 2-year Treasury, yet the Nasdaq's continuing to outperform. So it's kind of a weird situation currently.
I think weird sums up the last 3 years quite well. And it's been a very, very interesting market to navigate. So we've got, a clear idea what we were thinking coming in. We've seen it play out so far. We talked about a lot of the hot topics of what happened between, January and July now. Did we miss anything? Is there anything else you want to cover in that time frame that's kind of relevant to what we're looking at moving forward?
I'm sure we're missing something in there, but that's the gist of what's occurred so far.
That's the gist. So it really has been an interesting story, right? And it's, perspective is one of the greatest things we have, and we don't really have perspective until we're able to look back, right? And that helps us shape our ideas and thoughts moving forward on the market investment strategy, even on my side, the planning side of things. So I'll give you a little story. It's a bad one, but we'll throw it in here. So I was on swim team when I was a kid. I was never very good at swimming, but I was kind of nuts and my parents were sick of me. So in the winter, they needed a good activity to get me out of the house and burn some excess energy off. So coach put me in for the 200 IM medley, right? That's all 4 strokes. I was so excited because I'm like, man, coach must have thought I was really good to put me in this event. I'm so excited to go swim this thing, right? Unfortunately, as you get older, you get a little bit smarter, and I realized that you lose points if you don't put a swimmer in every event, and I was the only one they had left, right? It's kind of the bottom end of the totem pole.
And let me guess, it's the true Cinderella story where you came home with the gold.
Well, it was close. It was close. Everyone else was out of the pool and they were calling the next heat. And I still had a whole length of the pool to swim. And so my dad walks over and I was young, right? I was probably 10, 11 years old. And all these other kids are just bawling because they lost the race. And I get out of the pool. I'm like, Dad, you see that? He's like, yeah, I saw that. All right. And I'm like, Coach must have thought I was a really good swimmer to put me in that race. He's like, that's right, son. Go get him. So,
and that's why he kept me in the pool for so long.
That's why he kept me in the pool for so long. So, I think perspective can be such a powerful thing. And it's why we spend so much time in the data and the weeds here, is that it gives us the ability to make informed decisions moving forward. And on the planning side as well, we often talk, and I would say we've probably had a fairly negative tone about outlook for the market for a while now on here. We haven't been super optimistic. We're not bullish, but that's only a short-term perspective. I would say our long-term perspective is actually on the bullish side, because we know historically what market trends provide given longer term investment horizon. So when we're talking 5-10 years down the road, I'd say we're fairly optimistic depending on the situation. But it's my goal as a planner and my role as a planner to, listen to folks' stories, see what perspective they're coming with, maybe try to shift that perspective a little bit to focus more on the longer term than the here and now. The here and now informs Mike's decisions, and the here and now affect what I do, but it's much more the then and later that affect my decisions that I help folks make with regards to long-term planning. And Mike has to deal with the chaos that's happening around us here in the markets. So just a brief note about perspective, because I don't want people to sit here and listen to this and think that we're all doom and gloom and we're headed for a recession and the market's never going to recover. It's not anything like that at all. I think we need to be realistic about the current market scenario we're in. It's been bad. It'll be worse than it is now. That's the cycle of the market, and that's how things work. But when you're armed with that knowledge and perspective, it makes Mike's job easier. It makes my job easier. And so that's why we may come off doom and gloom, but we're nowhere near that. I always like to say the only people I can't work with are pessimists, because it's pretty true. If you don't have a positive outlook on your own future, how am I supposed to find one for you? So I'm done with my tirade. That's it. Go ahead, Mike. Take it back over. My soapbox is done.
No, that's pretty much it for me. For my forecast for the rest of the year, I'm going to steal a page out of the Fed's playbook. I'm going to be data dependent.
Touche. Love it. No planning topic for today. We wanted to dive in, focus on the markets, and go through that. Mike, thanks for sharing your expertise and knowledge with us. Always a pleasure. Everybody out there watching, thank you so much for joining us. We do this every Friday. It's usually a great time. I would encourage you to share it with your friends and family. We do our best to take complex financial topics and not bore the crap out of you. So hopefully you've got something out of this podcast. Any questions, feel free to reach out to us on social media, visit our website. If you have my cell phone, give me a ring. Would love to chat with you. Mike, thanks for joining me as always. Have a great weekend, everybody. Stay safe, stay healthy, and we will talk to you next week.
All right. Have a good weekend.